Hello, everyone. Welcome to today's session. Let's get underway here. Starting with the long-term market perspective here, looking at where we're at in this current bull market. We have shifted over to bearish in this bull market, and I'll show you what that means here in just a moment. We're seeing some of the shorter-term signals also retracing back down. We're seeing momentum back down into this bearish range, also seeing the breadth indicator in this trending location kind of stuck right here in the middle right now as we're coming into some final election numbers, and the market is going to have some volatility more than likely today and tomorrow as that presidential election sorts out. We're seeing the buy-sell ratio, the overall current trend, also seeing some weakness, 0.52. We're seeing that bearishness still in place with the buy-sell ratio red above green just means that we've got more sellers than buyers at this point, and that is where we're at currently in this market trend. We're seeing the sentiment, which is down below that 50% line, just stuck right here in this area, and that once we get to this underneath that 50% range, then we've got more bearishness. And that's the current trend. We are seeing a bit of a rally here today on S&P 500 and showing some support right where it should show some support, and that 568 range. So it's moved back out of that bearish trend zone with this move today. We'll see if it can continue to hold that area. And remember that these zones, when we shift over to a yellow or a red, we're just simply shifting structure and shifting into different levels of momentum. And it doesn't necessarily mean sell at that exact point. You can utilize that as a marker to be able to say, okay, there's some risk here. I want to be aware that this trend could be shifting, but you can get some volatility as that starts to happen. This is a good example when you get that first red bar and it gets a bounce back up again and it doesn't sustain, and ultimately it rolls back over. There's just clues that there is weakening starting to happen. It doesn't necessarily mean that weakening is going to continue, but oftentimes it does. That's just the early indication that the bulk of big institutional traders are starting to shift the market, and there's just a lack of buying as well. That can often be the case. There's a lack of buyers versus aggressive selling, and with some news with the presidential election, that can also come into play right here at these levels. So seeing a bounce here today, we'll see if that continues to hold up 1%. This is going to be a significant support area as we start to look at these ranges on support. Particularly, we're looking at this 6-month time frame, and we're looking at this area right here. We watch for these retracements, and each of these levels is just giving us more indication of that structure of the market. So we pull back. This upper range is the momentum zone, and typically you will see price activity retrace and hold inside of that zone if it's going to continue inside of that current trend. If it retraces and breaks through that first zone, then there's a high probability it'll get to this next zone and potentially even one of these. You've got a 382, 50%, 618. I typically will kind of reiterate these zones because these are support, resistance, supply, demand zones, and we would expect some kind of a reaction around these zones. And so we're seeing some support here, some buying start to come back in, and we'll see if it becomes if the buying demand is strong enough to overcome any kind of supply that's been created or is being created anytime you get a rally. Okay, once you get these rallies back up, if those become opportunities for sellers to say, thank you very much, we now have an uptrend and we're going to sell into that, we want to be aware that that's happening. And that is happening right now. We also want to go back to understand where we're at in this long-term trend. The real long-term trend, this 20-year cycle, we're right at the top of this trend right now. This momentum trend, which is the 1-year time frame, also at the upper end of that range. So a decent amount of risk in terms of probability of more upside versus downside is in play right here. We're going to see selective pockets of stocks that do well, but if the market realizes and decides that this is an area that is now going to retrace back down, and the presidential election could play a part of that, dealing with monetary policy and all of those things. The market's going to be paying attention to what's happening there, but it is starting to shift. We've seen this shift over the last few weeks, starting to see this decline here in sentiment, this decline here in momentum, and that is something that we certainly want to be paying close attention to at these levels. These are the areas where things can start to break down quickly, and we want to make sure that portfolios are structured. Where am I at here? Here we are. I was going to go back to the S&P 500 in a way that is we're taking appropriate levels of risk for the kind of time frame and the type of suitability that we are as individual investors and traders willing or able to manage. Okay, there's always risk. There's always risk in everything. There's risk in sitting in cash, and that is that your money may not grow to the extent that you need it to. There's risk in stocks that you want it to grow faster, but then you get a pullback or a retracement or a drawdown, and it takes a lot longer to recover those price pullbacks. And that's a risk of investing in stocks, is that you're dealing with volatility, you're dealing with fluctuation, you're dealing with potential loss of capital as well. So as markets are at these levels, we want to pay attention to what those levels are saying, and most importantly, how are we allocating risk in accordance with the current market conditions. Okay, so we know that we've got several scenarios that are unfolding here. We're still dealing with a little bit of a hangover from COVID, where we have a flat bond yield curve. We are seeing some shifts here in this. If I move this line over, you can see the short end of this yield curve is now starting to drop, and that long end of that yield curve is starting to move higher. So we are seeing that shift starting to take place in the money supply and the bond yield curves that we want to be able to see to have a little bit healthier yield curve that looks more like this. We want to see the short end of that yield curve lower, and that just takes some time for it to unfold, and it's going to take some time, particularly if it's broken anything in the economy, if it's broken anything with companies as well. So far, we really haven't seen anything real significant. The Fed has been dealing with inflation. That's been part of why they had to raise rates so quickly, is they needed to slow the economy. They needed to pull some of that liquidity out of the marketplace so that there wasn't so much money chasing these goods and services and pushing prices higher. And we're seeing a shift here where the bond market doesn't believe that interest rates are going to continue to be cut. In fact, the last Fed rate cut was back, well, where was it? It was actually right around this range, and the market had been anticipating it. And now the bond market is anticipating that the Fed either can't or won't cut rates, at least based on current data that has been out there. And again, this is the markets are simply a giant auction where everyone has an opinion and everyone can decide how they're going to invest in that overall decision and in that perspective. So TLT, the ETF for bonds, retracing right here, which means that interest rates have been climbing higher. SPY, or SHY rather, short end of that yield curve, it was holding up pretty well and then starting to get a bit of a retracement now. So deeper retracement on bonds. This could be an oversold bounce. We could see presidential election kind of provide some certainty to the bond market. We'll see how that unfolds. So in terms of risk in the current market, there is significant risk in full allocation towards equities, in my opinion, just based on where we're at in the price momentum. Okay, that's all we're really focused on here, is the price activity and the price momentum, and following what is happening with that overall price activity. We also are seeing that, getting some confirmation of that in the sectors where we're seeing weakening sectors. We should see most of these in a healthy market in the bullish zone. or at least the hold are going back and forth. So we don't have anything in the buy zone right now. Everything is either in hold, which is a transitionary zone, or we're seeing them into a sell zone. Okay, that transitionary zone, when we talk about those price patterns and those charts, are simply just, let's look at utilities here, because that had been in a really good uptrend here, and now you're starting to see utilities starting to shift as well. So when we get all of these in these price up zones or price zones in an uptrend, and then they start to shift. They're moving back into this yellow range, which is essentially that transition shift. It could transition into retracement and continue higher, or it can transition into a new downtrend. And so now we're getting more the momentum to the downside versus, and we want to trust that decision. We want to trust that trend instead of necessarily saying, oh, it's low, I'm going to buy it into this area, into this low. At least with the momentum methodology, we need confirmation. We need additional confirmation so that we're not just continuing to ride a downtrend. We want to be able to get that shift back into momentum. So now we're shifting in some of these sectors that you would consider to be a recessionary type sectors, like utilities, starting to break down here as well. Again, we don't necessarily need to read into that, other than the fact that we are getting trend momentum that is moving to the downside really across the board on these sectors. Commodities, let's jump over and talk about some of those here, since we've been looking at gold and silver, and USO, which is oil. Those have also been retracing and working on a bit of an area of support, or attempting some support. SLV, which is continuing to weaken. Also GLD, which is showing strength still in that momentum zone in this upper range, and holding. It's pulling back off of some of its most recent highs, but nothing too significant. It's hovering right on the edge, though, of shifting into that hold range, which it certainly can do and still maintain that upper momentum. USO, which is oil, has been trying to bounce and rally off that $70 low, that $69 low. So far, so good. It's got some work to do, but again, just a quick perspective of some of the leading commodities, or talked about commodities as well. If we jump over and let's look at, again, some potential, some ideas. Now, remember, one of the things that we're focusing on when we're at the upper end of the range. Now, we've been in the upper end of this momentum range really since March. Okay, so we've had a pretty conservative approach to allocation, really since we've been sitting up here around 19. Oftentimes 20, 21, 22, it'll top out. Started to top out there, and then we've just continued to have this upper momentum. So because of the location of momentum, we have had equity allocation of right around 25%, and the bulk in cash. Okay, so now there. The 2020 hindsight is fantastic, because you can always look back and say, we should have done this, or we could have done this. But when we're managing risk and we're managing the possibility of volatility and risk, then we've just got to do what we got to do in terms of managing that risk, and the outcome is going to take care of itself. We can't control the outcome. We can't control what the market or the stocks do. The only thing we can control is how big of a position size we're entering into, when we're entering, and when we are, and how our stop losses are managed. Okay, so in this case, we're sitting, portfolio is sitting. It hasn't moved a lot this year. It's been a relatively flat year, but part of that reason is because we had some whipsaw activity, and we've had some. We had some stop outs that were really painful on some of these names. It just happens. You can't write the perfect script. Some years are going to be fantastic and continue to be working. So in a lot of cases, when you're managing your own portfolio and you're managing your own equity positions, we get the extra flexibility to be able to do this versus just being fully allocated into S&P 500 or something like that, which isn't a bad strategy. I do recommend having a large percentage of assets in just something like a market type fund, S&P 500, or just SPY, and being able to have that for something that's a little bit longer term. On the flip side, there are always pockets that are moving. We've got a nice trade going in Palantir, PLTR, which has got a nice 22% move today and continuing that overall uptrend. Those are the kind of stocks we're looking for as they're entering into those uptrends. We want to try and capture as many of those as we can, and we're going to get some, and we're going to get stopped out of half the time on some that are working a little bit higher. Now, stop outs aren't necessarily a bad thing, because stop outs just help us from losing even more. Okay, so stop outs are just saying, and stop outs don't always necessarily have to mean a loss. For example, we had a stop out. It was this one, WULF was stopped out. We had raised the stop higher and it came back down and hit it. So we still profited 15% on that trade, even though it was a stop out. And sometimes they will stop out and then continue to move higher. But in that case, we followed our plan and we followed our risk management strategy so that we don't let a possible small loser turn into a big loser. And those two things we're focused on with allocation and the size of the position and the stop out. Or the stop loss location. Let's look at an example here. Here's a stock. This is going to be, a little bit more aggressive, higher risk, potential for higher return on a stock like this. LUMN is the symbol. It's a new buy as of yesterday, and meaning that has moved out of this hold range and back into this bullish momentum range here. Now it's gone up to the extreme range, which is okay. Just typically means that, you might get a day that looks like this, or 2 or 3 or something like this, where it has a big run up, it consolidates for a little while. And if it's in this upper momentum zone, that's ideally what we're looking for. Is we're looking for stocks that they're bouncing, they're finding some support, they're showing that there's some demand here, and then we get the confirmation of that happening. Okay, now what we can do is go in and say, if this was a stock that I wanted to trade, market conditions at these levels may deter me from buying anything new at this level, or saying, okay, I'm going to have a little bit, I want to add in, but I may add into a smaller allocation than I otherwise might add into. So let's go through an example here and say, if I were to buy this stock, again, pre-market, we'd be looking at the stock saying, I want to add into this stock. What are the risk profile that I need to be able to establish for my portfolio and the trade itself? So if I go into my portfolio, and let's start out with the number of shares. We know it's a $7 stock. So if we go 500 shares, that's 3%, which is too large for my trading plan. The trading plan is 2.5 to 2%. So if we come down and let's go to 300, that's 1.92% allocation. Okay. Now, we may not be able to keep that portfolio allocation if we have to have a wide enough stop that is going to adjust the number of shares. So if I wanted a really sound technical stop loss, I want to be below all of this price activity right here. The reason why is I know that there was buying interest here. There wasn't a lot of selling, and there was enough buying interest to push the price up through that area as well. Okay, so that's moving now back up into momentum, and I know that there's got to be institutions that are pushing that higher and in anticipation for some continued move on this stock. So a stop loss here, let's look at the low point on that. The low point is $6. So if I place my stop at $6, that puts me at 0.38 or $447 at risk, 20% on that trade. If that's within your trading parameters, then fine. If your portfolio at risk, maybe you go up 0.4, 0.5. That we're going a little bit more conservative with the 0.2 to 0.3 number. Okay, so if I want to keep my stop loss at 6, the way for me to adjust this number is I need to reduce my position size. So let's go down to 200 shares. That puts us at 0.25 now, or 3%. The trade percentage didn't change. Okay, nothing changed as far as where my stop loss is and the potential volatility. If I'm buying here, I'm allowing myself this much risk. If it comes down and retraces here, and then ultimately moves higher, I've protected myself at this level. If I get to this area, I'm saying what I'm willing to bet essentially, or risk in anticipation for more upside is $300 or 0.25 of my entire portfolio amount. I don't want to risk any more than that amount on any one given trade. That's relatively conservative. There is a trade-off between reward and risk, which means that if I get a massive gain on this, it's still only going to be $1,500 of a $100,000 portfolio. If it goes up 100%, my portfolio will make 1.5%, again, which is great, but it's about risk management because it's going to be the size of the position. When you're too big, it's going to be that one time that ends up blowing up and allows you not to stick inside of a methodology or a structured system for risk management. And so sticking with this, it just allows you to continue to make the trades. Some of them are going to be real big winners. Some are going to stop out. Some are not going to do anything at all. Okay, but understanding what is that risk that I'm willing to accept on a trade. Let's jump over here and look at that. So we said 200 shares at a stop price of $6. Okay, now if you're using Webull, we could go out here and let's see if we can add this in, or whatever brokerage platform you're using. I forgot the symbol already. LUMN. So I could go LUMN here, and this is the price pattern that's set up based on this. So I would go in and I would say, all right, my initial setup is going to be based on, and I could go ahead and set this up. We said 500 shares. I'm not going to enter in the number of shares, but in terms of just how we're setting this up, we can use the chart settings here. I would want to do first trigger and a stop. Okay, I don't necessarily have to do that as well. I could do a stop, and if I go into my buy zone here and I said this is our pre-market day here, so if we did our limit price here, actually let me go to this and change this over because I do want to have this perspective. We can add this in, buy it, set our limit price, make sure our stop loss is set. We said $6. Okay, and again, we can set our target up at this level. If you want to have that in place and leave that in there, then you know where your target is. And you know this is only 10 shares, so it's showing a profit of 21. But if you had the correct number of shares and you said, I'm willing to risk this amount in order to return to get a gain of this amount, then you could leave that order set up just like that, or you could just simply go in and and just delete that off. Okay, now we know where our risk is. The risk is inside of that red zone. We know that if it drops back to here, we will have lost that $239 or whatever that number was. That's our risk level. And then as the stocks are moving higher, we can adjust that risk level higher with a trailing stop loss as it's moving higher. So that's part of the analysis process, is understanding, it was 298 on that, is how am I managing the position size, the number of shares, and what is my method for determining that, and my stop loss location. Those are our two risk profile setups that we can control. How big of a position are we entering? Where is our stop loss? And then from there, we have no more control. Okay, we can't control what the stock does. If it goes up, if it goes down, it doesn't make us smart. It doesn't make us dumb. Okay, it's always fascinating when someone says, "I totally called that when I knew it was going higher." Well, did you know the one that stopped you out was going to go lower? No, you didn't. Nobody knows the future. Okay, all we do is we're focusing on the high probability facts, the evidence. The evidence in this stock is that somebody loved the idea of buying into this stock here. It's consolidated. It's still trending higher. It's still setting higher highs, and now you're getting some additional confirmation. Does that mean that it couldn't drop back down? No, it certainly could. And that's why we're saying I want to understand where my risk level is so that I'm not being stupid and I'm not gambling, okay, or I'm not just throwing some money at a stock and saying, well, I hope it goes higher. If it goes higher, great. If it goes lower, I don't know what I'm going to do. If it goes higher, I don't know what I'm going to do. Okay, that's having a plan, and the plan doesn't have to be difficult. It can be extremely simple, and that is essentially what we're going through in a lot of these strategies.